Hi everybody. This is the lecture for the last topic for this course, topic 10, capital budgeting or investment analysis. Okay, capital budgeting and decision making, and then definition of capital budgeting methods. Okay, let's see. Okay, objective 1. Explain the nature and importance of investment analysis. Okay, what is capital investment analysis? Capital investment analysis Capital investment analysis or capital budgeting is the process by which management plans, evaluates, and controls investment in fixed assets. So capital investment analysis is like this. If you are a manager, you have to invest in fixed asset. Sometimes you have to purchase new equipment or new motor vehicle. You have to purchase a new building or something. As a management, before you make a purchase of fixed asset, you have to make sure that you choose the best fixed asset for your business. So let's say at one time you are a manager and then you have to purchase machine, a production machine. So the basic way to choose that is you have to consider several alternatives. So this machine, before you purchase that machine, you have to consider maybe three brands. Brand A, brand B, brand C. Same machine but three brands, and then you have to choose which one is the best for your business. So in accounting, the basic way to find the best of something is to do a cost benefit analysis. Something that provide the best benefit or the highest profit, that is the best thing in accounting. The most profitable item is the best thing. That is what we do in accounting. We choose the most profitable alternative. Okay, I hope you understand what is a capital investment analysis or capital budgeting. It is an analysis that you do when you want to choose the best fixed asset for your business or for a business. So fixed asset is very important. So capital budgeting is very important. So these are the 4 factors that are related to capital investment analysis. First, management plans, evaluates, and controls investment in fixed asset. In a business, management has to plan, evaluates, and control investment in fixed asset. It has to be done properly. You cannot just simply buy fixed asset. Fixed assets are expensive, and sometimes you have to pay for the purchase of fixed asset for many years, and you have to use the fixed asset for many years. So it has to be done properly. It has to be planned, evaluates, and controls. Second factor, capital investment involve long-term commitment of funds. Okay, so this is the thing that you have to know. If you are a manager, when you want to purchase a fixed asset, you have to aware that it is a long-term investment. It is a long-term commitment of funds. When you purchase a fixed asset, you have to pay that purchase for many years. For example, you want to purchase a building for your business. you have to pay maybe 30 years. If you want to pay to purchase a motor vehicle for your business, maybe you have to pay for 5 years or 7 years. So you have to aware that about that. And number 3, investment must earn a reasonable rate of return. If you are a manager, when you want to purchase a fixed asset for your business, you have to make sure that the return from the purchase is higher compared to the cost that you pay for the asset. For example, if let's say you are a manager and then at one time you have to purchase a motor vehicle, a lorry for your business, then you have to make sure the benefit or profit that you get from the lorry is higher compared to the cost you pay for the lorry. If the cost is higher than the benefit, then you don't have to buy the lorry. You buy the lorry when the benefit or profit from buying the lorry is higher than the cost of the lorry. Number 4, the program should include a plan for encouraging and rewarding employees for submitting proposals. In a big business like public listed companies, when there are thousands of workers and there are many branches or segment in the business, most of the time the purchase of fixed asset is started by ideas provided by the lower level workers. They will send proposal to the manager or purchase this machine so that they can work more effectively and efficiently. So if you are a manager in a business in the future, you have to make sure that you include a plan for encouraging and rewarding employees for submitting proposals. When they submit proposals, good proposals should be rewarded, because good proposals means the workers propose to purchase good machine, increase the productivity and profitability of the company as a whole. Okay, I have said earlier, capital budgeting means, or capital investment means something that you do to choose the best purchase of fixed asset. When you a manager want to purchase a fixed asset, the analysis that the manager has to do to choose the best fixed asset for the business is called capital budgeting or capital investment analysis or proposals. Okay, so there are in these slides there are 4 methods that can be used to do the capital budgeting. The first one is, you see here in this slide, the first one is the average rate of return method. The second one is the cash payback method. And then number 3, the net present value method. Number 4, the internal rate of return method. In this slide, there are 4 methods. But according to the syllabus, you have to know only 3 methods. Method number 1, number 2, and number 3. Method number 4, the internal rate of return method, is not included in the syllabus of ACT3110. Okay, this percentage of method used in US. In US, they have done a survey. This is like many years ago, 2002. So from the 4 methods that can be used to do capital budgeting, you can see here, net present value method is the highest or the most frequently used method to do capital budgeting. Okay, so we see the average rate of return method. Okay, average rate of return method is one method that can be used to do capital budgeting. There are two advantages of this method. Easy to calculate, and then it considers accounting income or profit. There are two disadvantages. It ignores cash flow. Second, it ignores the time value of money. This method, the analysis is done by focusing on the profitability. When a manager want to purchase a fixed asset, using this method, the focus is to choose the fixed asset that will generate the highest profit. So let's see. Okay, this is an example. There is a proposal, and then to purchase a machine. So the machine cost is $500,000. Expected useful life is 4 years. Expected useful life of the machine. It means that the machine can be used for 4 years. Residual value is 0. Expected total profit that can be generated from the machine is 200,000. Profit means revenue minus cost. So, okay, one thing. Residual value is something like this. Residual value is the value of the machine at the end of the useful life. So this machine, the useful life is 4 years. At the end of year 4, the value of the machine is 0, according to this scenario or this example. So if these are the data, how to do rate of return, average rate of return analysis. So this, you have to use this formula. Average rate of return equal to estimated average annual income divided by average investment. Okay, you have to memorize this formula if you want to use average rate of return. So, okay, average rate of return, using the data that you have seen here, and then you use the formula. So average rate of return is 200,000 divided by 4. See, the estimated average annual income, the expected total income or total profit is 200,000. So the useful life is 4 years. So estimated average annual income is 200,000 divided by 4 years. That is calculation for the above of the formula. Below, average investment. Okay, remember this. Average investment, to calculate average investment, first see the machine cost 500,000. That is the investment, plus residual value. In this sample question, the residual value is 0. If there is a residual value, then you have to add the residual value, and you have to divide this number by 2. That is average investment. Okay, you have to memorize this formula. So for this scenario, the average rate of return is 20%. So for example, a manager has to purchase something, and there are two proposals for this purchase, proposal A and proposal B. Let's say we can say that the fixed asset A and fixed asset B. Which one is the one to choose? So if that is the situation, and then the method that the manager use is average rate of return method, then the way to choose the best alternative is like this. You have to calculate the average rate of return for both proposal. So in this example, proposal A, the average rate of return is 25%. Proposal B, the average rate of return is 20%. Then, after you have calculated the average rate of return for these two alternatives, you choose the best one. So which one is the best one? For average rate of return method, the higher the percentage, the better the investment. In this example, proposal A, the average rate of return is 25%. Proposal B, it is 20%. So it is better for the manager to accept proposal A and reject proposal B, because proposal A, the average rate of return is higher compared to proposal B. Okay, this is a sample question. Let's say the question asks you like this. Determine the average rate of return of a project that is estimated to yield total income of 273,600 over 3 years and cost of 690,000 and has a $70,000 residual value. So if the question asks you to calculate the average rate of return, then you remember you use the formula. Okay, you use the formula. The formula is average annual income divided by the average investment. Remember how to calculate the average annual income. The average annual income is the total income or total profit divided by the years. In this scenario, the project is a 3 years project. So $273,600 of income divided by 3 years. So the average is 91,200. And then how to calculate the average investment? Okay, I have told you earlier. Average investment equal to initial investment 690,000 plus residual value. In this scenario, residual value is 70,000. And you have to divide by 2. So equal to 380,000. So you just divide the average annual income with average investment, and what is the percentage? So the percentage is, for this scenario, the average rate of return is 24%. Okay, this is the first method. Okay, the second method is called cash payback method. Cash payback method is the expected period of time that will pass between the date of an investment and the complete recovery in cash or equivalent of the amount invested for the purchase of a fixed asset. So payback period is a method that shows for the time needs for a business to get back the cash that they have invested for the purchase of a fixed asset. Let's say a business want to purchase a machine, and there are two alternatives, alternative C and D. So if the business use this cash payback method, the business will calculate how many years it takes to get back cash invested for machine C, and how many years to get back cash they have invested for machine D, and they compare, and they will choose which one is the best investment. Okay, the quicker the business can get back the money that they invested, the better the investment. So you will see that in this example. Okay, this method focuses on cash flow. Cash flow means cash in and cash out. So in the average rate of return method, the focus is on the profit or the income. Here, in this payback period method, the focus is on cash flow. Net cash flow means cash in minus cash out. That is net cash flow. When you purchase a fixed asset, there is a cash out because you pay. And then when you use the fixed asset, there will be cash in because the fixed asset is supposed to generate revenue. Let's say you purchase a machine. When you purchase the machine, you have to pay some amount. That is cash out. After you purchase the machine, you use the machine to produce something. Then you sell the product. That is how you calculate the cash in from the machine. Okay, let's say this is an example. Okay, let's say a business need to do an investment, maybe purchase something or start a project or anything. The investment cost is $200,000. Expected annual net cash flow equal to $40,000. So it means that every year the business will get net cash flow 40,000 from the investment. So how to calculate cash back period? It means that how to calculate how many years it takes to get back the cash that they have invested. So the cash back period, when the expected annual net cash flow is equal every year, then you can use this formula. Cash back period equal to total investment divided by annual net cash flow. So from this you can see that you put the number. The total investment is 200,000 divided by annual net cash flow is 40,000 per year. So you can see that the cash payback period for this investment is 5 years. It shows that the company will get back the cash that they have invested for the investment in 5 years, in year 5. Sometimes the net cash flow is not same every year. In the previous slide, the net cash flow is same every year, 40,000 net cash flow. But sometimes you purchase an asset, but the net cash flow that you can get from the asset is not same every year. For example, you purchase a machine. You're a manager in a business, and then you purchase a machine to produce a new product for your business. So when you purchase the machine, most of the time you will pay some amount when you purchase the machine. That is a cash out. So for cash in, most of the time for a new product, in year 1 you will not get much from a new product because you just introduce the product to the market. Second year maybe you get more, you can sell more. Third year maybe you can sell a lot if the product is popular. And then after that, maybe the sales and the cash that you can get from the product will decrease, because maybe the product is also already 4 years or in the market, so people interest will decrease. So when you see the trend, first year you get maybe a small net cash flow. Second year you get more net cash flow. Third year you get a lot of net cash flow. Fourth year the net cash flow is start to decrease. So it shows that sometimes the net cash flow is not same every year. So if the net cash flow is not same every year, then you have to use this table to calculate the cash payback period. For example here, if the proposed investment is 400,000, the payback period is at the end of year 4. How to calculate that? So the net cash flow, you see the net cash flow are not same every year. So you have to prepare this table. Year 1, 60,000. Year 2, 80,000. Year 3, 105,000 net cash flow. Year 4, 155,000. Year 5, decrease net cash flow, 100,000. Year 6, 60,000. So you have to calculate the cumulative net cash flow. Year 1, 60,000, cumulative 60,000. Year 2, 80,000. So the cumulative is 140,000. How to get the 140,000? Cash flow from year 1 plus cash year from year 2. Year 3, net cash flow is 105,000, but the cumulative is 245,000. How to get the 245,000? Net cash flow from year 1 plus year 2 plus year 3. And you can see there, in year 4, the company get back cash from that they have invested. They have invested 400,000. In year 4, they get back 400,000. So the answer for this is year 4. So you can use this graph to find the payback period for net cash flow that are not same every year. So you can prepare the table, and then you can draw a graph, and then you can get the cash payback period for years if you want. But if you do not use the graph, still you can calculate by seeing the cumulative net cash flow, and then you can find the cash payback period. Okay, the advantages and disadvantages of the cash payback method. Okay, you can see the advantages. The advantages, the first one is considers cash flow. So this method focus on cash flow. Cash flow is a good thing to focus if you have a business, because if you have a business, you have to have a good cash flow. If you have sufficient cash for your business, then you can continue the operation of the business. You can pay the salary of the workers, you can pay rental, you can pay utilities, etc. But if you do not have sufficient cash, it is going to be very difficult for your business to continue operation. So that's why if a method focuses on cash flow, then there is a good method. Number 2, shows when funds are available for reinvestment. So this method is good. You can see in the previous slide, the cash payback period is 4 years. So that method, that number shows that after 4 years, the business can purchase a new machine or make a new investment, because they have recovered the cash that they have invested. That's the good thing about cash payback period. And then there are 2 advantages. The first one is this method ignores cash flow occurring after the payback period. When you use this method, you calculate or considers only cash flow before the payback period only. After that, you ignore. So that's one weakness. Second is does not use present value concepts in valuing cash flows occurring in different periods. So present value is very important. I hope you have learned about present value when you do mathematics for business or something. Present value concept is very important. Present value concept is something like this. You calculate the value of cash by considering the interest rate, because if you have cash and you put the cash in bank without purchasing any fixed asset or involved in any project, you just keep your cash in bank, you will get interest income. So the longer you keep your cash in bank, the higher the interest income. So when you want to do investment capital budgeting, whether you use internal rate of return, average rate of return, or cash payback method, you have to include the effect of interest in the calculation, but this method does not. Okay, this is the end of this video lecture, and in the next lecture I will explain method number 3, net present value method. That the net present value method is also one method that can be used to do capital budgeting. That the net present value method can be used to evaluate whether the investment is a good investment or not. Thank you very much. Do not forget to write your name and metric number in the comment section. That is your attendance. And wait for the next lecture.